Now that we understand classical and Keynesian economics, our next task is to look at basically a case study for us. Between 2007 and 2009, the U.S. economy entered what was probably the greatest recessionary gap since the Great Depression. And certainly there was one case in the 70s that was bad as well. So either the worst or the second worst case since the Great Depression. A really atrocious time for the U.S. economy. And so what we're going to get into this chapter is what led up to it, the causes of the Great Recession, and then what choices the government made in terms of dealing with the Great Recession. I choose to cover this chapter now because I think it's a good time to think about classical versus Keynesian economics and to see how our actual government responded to a really horrible recession. So this is chapter 18 in the book. If you have the same edition that I'm looking at, make sure you check out the chapter. If you've got a really old edition, the chapter may be listed a little bit differently, or it may not be in there at all. So just my recommendation would be to watch this video and take notes. I'm not sure how many of you are doing that, but that would be my recommendation. And reading the book would be helpful, but probably the video is what's most helpful, certainly for this chapter. And the reason being is we're going to cover some stuff that actually isn't discussed in the chapter because I want to give you guys a feel of everything leading up to it in regards to the recession. So part one of this chapter, I'm going to title The Boom. And this is to think about what happened prior to the Great Recession. And one potential problem with an economy that's really strong is the potential for inflationary gaps. And some have argued that maybe there was an inflationary gap leading up to this time period. To illustrate that point, let me just give you some data. This is real data from the Bureau of Labor Statistics and the Bureau of Economic Analysis. If you're ever wanting to look up economic data, it's really easy to do so. Bureau of Labor Statistics and Bureau of Economic Analysis are two really good places to find data. So here are our unemployment rates during this period and our real GDP growth. And so this is going basically the 10 years prior to the start of this, what sometimes is referred to as the Great Recession. And here are the unemployment rates. This is for the U.S., of course, and what you'll see here with the unemployment rates is looks more or less like business as usual, but you do have a period here where we go below 4.5%, and it's a little bit uncommon to see the unemployment rate below 5% for so many years. The natural rate of unemployment is something that we don't really know what it is. It's more of an idea. In this class, we've suggested 4.5%, but others have thought maybe it's 5%. So you basically got 4 periods here out of 6 where the unemployment rate is below 5%, which is a little unusual for the unemployment rate to be so low so often. And the growth in the economy is also illustrated by the real GDP growth. We haven't talked a lot about real GDP growth, but what's typical today in our current economy is around 2%. All right, 2% it would be a good growth rate now in the U.S. This year will probably be higher than 2% in 2018, but in recent years we've been below that many years. So these growth rates here are quite high. 4.5%, 4.7%. Those are really high growth rates. 2.8, 3.4. Those are pretty high as well. So you've got pretty quick growth between 97 and 2007. And so the question is why? Why was the economy so strong? And we need to give some reasons for that because it will help us understand why the economy got to where it was in 2007, 2008. So why was the economy so strong from 1997 to 2007? Kind of arbitrary, honestly. I'm just looking at the decade before. I could go two decades back and the story really wouldn't change much. The question is, why was the economy so strong leading up to 2007, which is the time period where things really started to go haywire in our economy? Probably the biggest reason is we had a large population of ideal aged workers. And this, if you know a little bit about history, this has a lot to do with actually World War II. So basically, after World War II, if you're not familiar with U.S. history, World War II was from 41 to 45, something like that. After World War II, population exploded. And the reason for that is a couple of reasons. One, literally, people are coming back from the war. Their life has been on hold, so they start having kids. But two, the period before this, if you look back to, say, the 1930s, we had the Great Depression, okay? And then the beginning of the 1940s, we had World War II. People really pessimistic. Not a time where you're like, I really want to have kids, right? If the economy's really bad and times are really tough and you have a world war, you probably think to yourself, I don't really want to bring a child into this world. After World War II, people were super excited and so much more happy to be alive, and they were ready to have kids. So the population grew at a really fast rate during this period. There were more than 4 million births per year in the U.S. between 54 and 64. And 1957 is the most common birth year in the United States. So the birth rate was really fast, faster than it even is today. So what ends up happening is, in the late 90s, for example, all right, in the 1990s, you have a bunch of people that were born in the 50s and 60s. These people, these babies that were born after World War II, which are often referred to as baby boomers, were in their 40s and 50s, some in the 30s as well, which means they're very in their prime productive years. If you look at people's earnings and their productivity, people tend to peak, late 30s all the way up to maybe their mid 50s is their most productive years. So this is their most productive years, and so the economy is bound to be very successful when you just have this group of people working. So that's one reason why the economy was growing so fast, is you just had the perfect population for high economic growth. Other reasons: relative peace and stability. Well, obviously we had 9/11 occurred in 2001, but overall the period here is pretty peaceful. No major wars. Major wars, of course, can slow down economic growth and slow down population. We didn't have any of that going on, so things were pretty peaceful in the U.S. Not a lot of political strife other than 9/11 and the related incidents with that. You had the boom from the internet. Internet encouraged a lot of economic growth. One major reason why the internet is so important for economic growth is it makes communication a lot easier. So if I'm buying something from somebody in Japan, I don't have to learn Japanese, they don't have to learn English. It just makes communication a lot easier. So think about how you buy things today. You probably buy a lot of stuff online, maybe on Amazon. That wasn't an option. When I was a kid, that wasn't an option. So when it becomes a lot easier to purchase things, it tends to spur on economic growth because things get to become cheaper. So for example, if I'm selling, let's say I make hats and I sell them in person, a big portion of my expense is going to be to have a physical store. And if I'm selling stuff abroad, it's going to be to learn languages or hire interpreters and things like that. Today you don't have to do that. If I want to sell hats, I can sell them online and I don't even have to have a physical store. So it drives down costs, makes it cheaper to produce, which means you can produce more because your costs have gone down. So the boom from the internet certainly during the same period really helped the economy grow. We had continued improvements in human capital, which I don't know if that's a term that we've defined in here before, but human capital is basically anything that goes into education or training. Anything that makes you a more valuable worker is referred to as human capital. So for example, if you are really good at typing, that's one piece of your human capital. So during this period, Education continued to improve. More people are going to college than ever. And when that happens, people become more productive. It helps spur economic growth. So you've got a lot of things here that help towards production. And so production grew very quickly, as we saw with the data at the beginning part of this lecture. And so there's a lot of consequences with economic growth. Economic growth is usually a good thing. In this case, it was a good thing. But we had one market that had really an exaggerated growth. You may have heard of something called a bubble in economics. You may have heard of, for example, the Bitcoin bubble, the idea that Bitcoin went up in value because people were buying into it and then it crashed, so it was a bubble. The bubble bursted. We had a bubble. We had a bubble in 2000, probably all the way back from, say, 1990 up until this Great Recession, that a lot of people didn't recognize was a bubble. That's how bubbles usually work. So one important consequence of such growth is exploding housing prices. Exploding housing prices. Housing prices during this period rose really quickly, a lot faster than is normal. So we need to make sure we talk about this and why it was happening so we understand how we can avoid these sorts of problems in the future. So think about why. Why would housing prices rise so quickly? One reason is optimism. People were really optimistic about the economy and optimistic about housing in general, and their wealth had risen very quickly. As we showed with GDP growth rates and unemployment rates at the beginning of this lecture, we were in a very strong economy, and when the economy is very strong, people can afford to buy houses. So people were becoming more and more optimistic about the economy. The style of mortgages, which we're going to have to talk about a lot in this lecture, had changed to make it easier for people to borrow money. So we're going to have to look at mortgages and see how they actually operate and how they changed over time. The style of mortgages is probably what really is to blame for the way the housing market is going to crash in 2007, 2008. And a third real important reason here for why housing prices rose is people saw houses as a can't-miss investment. Key word there being investment. When you buy stuff, you usually don't think of it as an investment. So, for example, if I buy a coffee, I don't think of that as an investment. I think of that as just purchase, something that I'm going to consume. But a lot of people viewed housing as part of their wealth. Housing was basically part of their savings. Housing was a retirement plan. Housing prices had always gone up. People expected them to continue to go up, so they put a lot of money in housing and viewed it as part of their retirement plan, which is probably not a really good way to think about housing, because housing is an asset that can lose value very quickly. And it's also undiversified. All right, if you're planning on investing, what you want to do is have your funds in a lot of different baskets so that essentially if one fails, you'll still be okay. It's diversification, right? That's really the number one rule of saving for retirement is diversification. Well, if you have a $1 million house and that's most of your savings is in this house, that's very poorly diversified. So if something happens, you could lose a lot of your wealth very quickly. So to show what this looked like, we need to actually think about the housing market and the way it looked. So I'm going to call this the housing market pre-crash. So maybe this is what's happening in, say, for example, the year 2000. Okay? Housing market is ruled by supply and demand, just like any other market. So we're going to talk about the housing market with supply and demand, and this is something you've seen before. All right, you've seen supply and demand, so this is nothing new in terms of the graphs. So here's the quantity, here's the price, here's the supply, and here's the demand. And the market for housing has an equilibrium, and maybe the equilibrium price is $140,000 in 2000. And you've got some quantity down here. Okay. Market for housing is ruled by supply and demand. It's a little bit different from regular markets in that it is very imperfect. Houses are all very different. If you've ever been involved in a house purchase or a house sale, it's a lot more difficult than, say, buying a coffee, right? So it's a market that takes a long time to adjust, to reach new equilibria. So that being said, let's use supply and demand as a way to analyze this, but let's keep in mind that supply and demand is a bit limited in terms of how it views housing market, because the housing market it's unique. So here's the basic problem here. What if people expect housing prices to rise? Now, why would people in 2000 expect housing prices to rise? There's a lot of reasons why. The economy had been doing really well, so housing prices had increased over time. There's the old adage that, we're not making any more land. The amount of land out there is fixed, so prices are going to keep going up for land and housing. There is some sense to that. There is some logic to that. And people, again, think about the economy now. There's a lot of people in their 40s and 50s that are buying a lot of houses. They're trying to think about their retirement, and they're thinking about housing as one way to save. When you buy a house, you pay your mortgage, eventually you own the house, and that's kind of like owning wealth, because you can always sell it if you have to. So if people expect housing prices to rise, think about the effects on demand. If you think that houses are going to be more expensive in the future, okay, do you want to buy a house today? If you think the housing prices are going to be higher in the future, do you want to buy a house today? Of course you do, right? You want to buy a house today because you want to buy it before it gets cheap. So the effects on demand, one, you want to buy the house before it gets more expensive. Which makes a lot of sense, right? If I'm thinking about buying a house and you tell me, well, housing prices are going to double in the next 2 years, I'm buying a house today, right? I'm going out there and I'm finding a house today to buy because I don't want to have to pay the higher price in the future. So you want to buy a house before it gets more expensive. So that is going to make you really want to buy a house today. And secondly, you might want to buy the house in order to sell it in the future. 1 and 2 here, the two that I've listed are very similar, but they may affect two different types of people. Number one might be somebody who doesn't have a house, right? I've been saving money for a down payment, and you tell me houses are going to be more expensive in the future. Okay, I'll buy a house, right? Number two might be somebody who has a lot of money, somebody who already has a house. If they think housing prices are going to go up, they may say, well, let me buy the house today and sell it in the future. Not for a place to live, but just for basically as an investment. So overall, what this is going to mean is everybody wants to buy a house today. So demand is going to rise. And that's the effect, right? Increase in demand. And this is where we were. People saw housing as really a can't-miss investment. They wanted to buy the house while it was cheap. They didn't want to pay those high future prices, so they bought in today. So housing prices are going to start going up. That's what you see by this increase in demand. That's not the only thing that happened. We also have effects on supply. So the effects on supply, when you're thinking about the housing market, most houses that are sold are houses that already existed, right? If you look at, go through real estate listings of houses for sale, most of those houses have sold before. They're not new houses. So most of the supply of houses actually comes from houses that are not brand new, okay? Furthermore, if you are selling a new house, the land has always been there at the very least. So what you have basically is a market that kind of operates like a used goods market, All of these things already exist. The reason I point this out is if you want to increase supply, that's actually pretty tough because there's only so much land, and to build new houses is very timely. It takes a lot of time to do that. So that being said, let's think about the effects on supply. For those owning a house, think about how you would react to this, right? If we know that housing prices are going to go up, do you want to sell your house? No, you don't want to sell your house. You want to wait to sell your house. You want to sell your house after it goes up in price. So for those who own a house, they don't want to sell. Okay? For those who own a house, they don't want to sell. So that's the overriding effect on supply. Now you might be thinking, we can always build new houses. But if you build a new house, you don't want to sell that either, do you? You want to build a house and you want to wait and then sell it in the future when the housing prices go up. So people are buying land and holding on to it, speculating on housing, and people don't want to sell their house. So how does that look on the supply curve when people don't want to sell their house? They learn that prices are going to go up and they say, I don't want to sell a house now. That decreases their willingness to sell. That decreases the supply curve for housing. So what we have here is an increase in demand and a decrease in price. And what that does is that raises prices to maybe $210,000. So prices go up. The problem with prices going up here, is that's going to confirm all of these beliefs that these people have. This is really an amazing thing in economics, where if people think something is going to happen, it often does happen. This is sometimes referred to as expectations theory, the idea that expectations can create a new reality. So if consumers think prices are going to go up, and the people who own homes think prices are going to go up, they will go up. And the problem with that is, once that occurs, they're even more convinced that this is going to happen again, right? If you think housing prices are going to go up and then they do, you think, wow, I'm really smart. Well, I think they're going to keep going up because I thought it before and my beliefs were confirmed, so they're probably going to keep rising. So this is just going to keep occurring over and over again, leading to higher and higher prices over time, okay? So that's where the bubble gets built in terms of the housing market. Prices are going up, 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 and up, okay? So this is a big reason, okay? If we're thinking about why housing prices go up, a big part of it is just people expect housing prices to go up. But another important reason is mortgages and the way mortgages were set up. So what we're going to talk about now is different types of mortgages, okay? And just to be clear, just to make sure we understand what we're talking about, let me define mortgage. This is an agreement between a borrower and usually a bank, right? Some sort of financial institution like a bank or a credit union. An agreement between a borrower and a bank where the bank purchases the house and the owner basically pays them back. The borrower is going to pay them back. Over a long period of time. Okay, and most people in the U.S. will get involved in a mortgage at some point in their lives. The basic logic here is this is a symbiotic relationship between the bank and the borrower. The borrower is going to be able to get a house that they otherwise couldn't afford. Houses are very expensive. A $300,000 house, very few people could afford that with cash. So what happens is the borrower borrows money for the house, and then the borrower is going to pay back the bank. So the borrower gets a house that they otherwise couldn't afford, and the bank is going to get interest off of it. Okay, so the bank receives interest. In other words, the borrower is going to end up paying the bank more than the bank had to pay for the house. So the bank comes out ahead because they get interest, and the borrower comes out ahead because they get a house that they otherwise could not have afforded. Okay, so that's a basic mortgage. If we go back to, say, 1970, you would have traditional mortgages. So for example, in the 1970s, this is how most mortgages would look. So in this example, let's imagine that there's a house priced at $100,000, okay? If there's a house priced at $100,000, there's going to be, first of all, a down payment required, okay? The down payment is money paid up front by the borrower. Okay? Down payment is money paid up front by the borrower. In a traditional mortgage, this would be 20% oftentimes. And this is still the case today. A lot of mortgages are at 20% down payment. The reason 20% is so common is because if you pay 20% up front, you actually get some governmental cuts, essentially. Basically, you pay a fee to the government if you go less than 20%, okay? So there's a kind of, right at 20%, there's an inflection point that gives an extra incentive to the borrower to pay at least that amount. So for this $100,000 house, the down payment would be $20,000, and then the homeowner would owe $80,000 plus interest. So that's a traditional mortgage, and that's the way the mortgages mostly would have looked in the 1970s. Okay, so you're going to pay back $80,000 plus whatever interest there is, so you end up paying far more than $100,000 by the end of the contract. And generally speaking, the length of the mortgage is actually a really long period of time. The most common length of mortgage is 30 years, which means it takes 30 years to pay back the house. Often that long period is done because it makes the housing payments lower for the homeowner during that stretch. But the problem with that is, of course, if you're paying for 30 years, you're going to end up paying a lot more interest because interest payments grow with more time, okay? So that's a very traditional mortgage. And let's think about what this down payment does. This down payment ends up being a critical aspect of this housing market. All right, this is probably the most important thing to focus on here is this down payment. That's what we're going to be sure to focus on. So here's the importance of the down payment. There's a few things we need to point out about this down payment. One, the down payment requiring at least 20%. Okay, let's be clear. Requiring at least 20% on the mortgage is going to do some powerful things. One is it's going to provide a signal. If a person is able to save, in this case, in the example we just looked at, $20,000 for a down payment, they're probably responsible. It's no guarantee, okay? But if somebody is able to save $20,000, it means they're more likely to be responsible and they're more likely to earn money. In other words, put it this way. Let's imagine there's two groups of people and you don't know anything about these two groups of people, but they both want to buy a house. And one says, oh yeah, I've got $20,000 for a down payment. And the other says, I can't afford a down payment right now. Okay? You don't know for sure, but the group that has a down payment you might think is more capable of saving money and more responsible. Okay? So this is going to provide a signal in the sense that it'll help us identify those that have the ability to save money, the responsible ones, and only give those people mortgages, okay? So it's going to help sort the groups between those that can earn and save money and those that can't. A second thing that the down payment does that's very powerful is it provides an incentive to repay. provides an incentive to make payments, okay? And to understand why this is the case, we need to understand how the mortgage works. If a borrower is unable to make payments, the bank gets the house. All right? So I'm not going to write all this down because it's a mouthful, but this is how a mortgage works, okay? And then probably a lot of you understand this already, but I might owe $800 a month, and I'm going to keep making my $800 payments. But if I get to a point where I can't afford it anymore and I stop making payments, eventually the bank is going to take over the house, and I'm the homeowner, I'm just out of luck, okay? Think about what that $20,000 down payment is going to do. If I'm unable to make my payments, I lose that $20,000. That's not recoverable, okay? That down payment is lost. So the down payment is going to create quite an incentive here. Since I know I'll lose $20,000 if I default, okay? And that's the terminology used here, meaning to stop making the payments if I default. D-E-F-A-U-L-T, default. So since I know I'll lose $20,000 if I default, I'm more likely to make payments. Okay? Which means that I'm only going to enter this mortgage if I'm pretty confident that I can pay it back. And secondly, once I'm in the mortgage, it's going to make me really confident or really incentivized to keep making payments. Meaning, if I walk away right now, I lose the $20,000 plus all the other payments I've made on this house. So because of that, I'm going to be extra diligent about being sure I make my payments because I don't want to lose that 20 grand that I put up front. So the down payment, which seems kind of like a simple thing up front, is actually very important because it does two things. One, it helps us pick people for mortgages. And two, once they're engaged in a mortgage, it makes them more likely to pay. So it helps us get the right people in, and it helps to make sure they repay the mortgage, okay? So traditional mortgages get results. Traditional mortgages mean that lots of people are repaying for their homes. We don't have a lot of defaults, okay? So with traditional mortgages, defaults are uncommon. All right, traditional mortgages meaning putting at least 20% up as your down payment. Over time, this came to change, and we moved away from these traditional mortgages, and that's going to be the start of the next video. It's really quite a tipping point.